Hi, what's up, guy? I'm Edwin. Today, I would like to talk about free cash flow. When we are evaluating a company, the first thing we would like to evaluate would be its profitability. So when we subtract the cost from revenue, we can get the profits, and then, but this profitability does not imply the cash flow ability. So we need another measure, free cash flow, to estimate company's cash flow position. So why is so important in measuring company's cash flow position? First, cash flow is a better measure in estimating financial health because profit is more easy to be affected by different accounting practice or even by manipulation. So when we use the cash flow, we can actually better estimating the company solvency. So second, high cash flow provides greater flexibility to the company in distributing dividends. So for those investors that chasing dividends, maybe they should look at the free cash flow rather than the profitability. So third, when we talk about valuation, we consider about the time value of money. So when we value a company, we will use free cash flow more frequently than profits. So therefore, for both company and individual, free cash flow is still an important indicator for us to make our decision. So you may want to ask why there is a difference between profit and cash flow. So one of the reasons is that there is a time lag between the profit and loss recognitions and cash flow incurred. So let's just use a mobile phone case as example. Now assume that you purchase a 10,000 mobile phone in 2024 and plan to use it for 5 years. Then the cash outflow will only be appear in 2021. On the other hand, as you plan to use the mobile phone for 5 years, the cost per year should be 2,000. Now you can see that the concept of cost and cash outflow are not the same. So if we ignore the differences and use cost as a proxy for cash outflow, we will actually underestimate cash outflow by $8,000 in 2021, while overestimate the cash outflows by $2,000 in the following years. And that goes back to the company level case. So although capital expenditure needs to cash outflow in a year, but some of the expenditure will be recorded in the following years. Therefore, profit in that year would be higher than the cash flow in that year. So in contrast, depreciation like a sharing of previous capital expenditure, so which can lead to a situation that the reported profit is lower than the cash flow on the same year. And then how about credit sales? So credit sales would make the reported profits higher than cash flow because when we make credit sales, we regard it as revenue, but the cash has not yet um, received. So other than these three items, there are much more factors that can contribute to the difference between cash flow and profit. Now is the time to talk about how to calculate the free cash flow. First, we start from earnings before interest and taxes, which equal to revenue minus costs except interest and taxes. So second, we add back the depreciation because it's a non-cash items. And third, we minus the taxation. Then now we will have the operating cash flow. And next, we take into account of the capital expenditure. And finally, we subtract the change in the net working capital. And then we can get the free cash flow in a particular year. So how can we use this free cash flow? So let's say if we want to value a company, then the key step is to forecast the free cash flow for this company in the coming few years. And then with this series of free cash flow, we still need to make some assumption to simplify our model. And then by discounting the series of free cash flow, we can have the company value. And when we subtract it by the debt value, we can find out the value belongs to the shareholders. So at last, we can get the fair value of the stock by dividing the equity value by the number of shares. So you get the fair value, and if you find that the fair value is higher than current market price, then it means that you would like to buy this company because it seems that it's underpriced. Now let's conclude what we have talked about today. So we talk about the differences between the profits and cash flow, and then now we know the importance of cash flow, and we also know how to estimate the free cash flow. And finally, I introduced how to do a simple stock valuation using the free cash flow. So that's all for today. So hope you enjoyed the video. If you like the video, remember to like my video and subscribe my channel. I'm Edwin. Thanks for watching and see you next time. Bye.